off.
Welcome everyone. Andrew Woodward here from the Investors Way, and joining me today is Colin Lee from Inspire, and we're going to be talking all things property, wealth, retirement, any of those type of topics. We're going to try and delve into those and give you some insights on what we're seeing, hearing and doing in the financial markets today and tomorrow. So Colin, thanks for joining me.
Thank you, Andrew. It's always been a pleasure. This is our second fireside chat, I like to call it, but it's been incredibly insightful just to listen from you as well, and certainly happy to share some of my thoughts and observations in the last month since we've chatted.
Yeah, awesome. And look, I know today we've got a broad range of topics we wanted to cover, so I'm going to dive in. I've got a few questions I want to get your insights on. And I know you've got some for me, so I'll hand over control to you after I've got your responses on a couple of questions. So these questions that I'm putting to you today are things that I'm starting to hear more of in the conversations I'm having with people, and I'm sure you're hearing similar things, so hence why I wanted to get your insights. And the first one's, what's your general outlook for the rental market in 2023?
Yeah, really good question, Andrew. I think it's going to go beyond 2023. My high-level predictions are it's going to be happening for certainly the next handful of years. I can't see beyond what's going to happen beyond 2025, 2026. But there is a lot of statistics out at the moment where the international migration doors are already open. So if you already don't know, there is more and more people coming through to the borders of Australia. I was traveling to New Zealand only last week, and the flights are absolutely chock-a-block full. And the international airport where I was is just, I just couldn't believe it. It was like back to normal. So I'm seeing a lot more travel happening, that's for sure. But our borders are now, I think the intake for 2022, 2023, as announced by the federal government, they're opening the doors to 190,000 international migration people coming in. These are both skilled migrants and family migrants coming into Australia. That's up 30,000 compared to what was happening in only the last few years. Yeah. And I think there is about also a 35,000 intake for humanitarian visas. Right. So you add it all up, there's going to be about nearly 250,000 people coming into the shores of Australia in the next few years. Now that's the prediction. Whether that's going to happen, we don't know. But I certainly have wanted to come to Australia for many years before I came to Australia. Australia is the lucky country. So what that means from a rental demand perspective is you've got people that are traveling internationally that comes into the shores of Australia. They're not going to buy a property straight away. So guess what they're going to be doing? They're going to be renting. Yeah, so what I'm finding is you're going to be competing not only interstate. So in Brisbane, where I'm at the moment, you're getting a lot of interstate migrants, about 1,000 a week coming into the shores of Queensland at the moment. So you're competing with the Sydney-siders, bless them, the Melburnians. Those are the two major cities. That's where they're coming from for the sunshine, Yep. And now you're competing with international migrants. So my guesstimation is that it's just going to get tighter and tighter and tighter. And then we're not building properties fast enough to be able to satisfy the demand for the rental market. So that's my guesstimation. Yeah,
and with those rising costs for building, that there's more or less and less building being undertaken.
Correct.
So
builders are holding off, Andrew.
That's right.
I've spoken to at least a handful of builders just in the last couple of months, and they're all saying we're waiting until 2023, maybe even 2024, for the trades costs to come down, for the materials costs to come down before starting construction. I mean, they're not profiting anything, and it's hard to sell to a client before. I mean, we were doing some constructions for 400,000-500,000. Now it's 600,000. So it's a pretty significant increase, and a lot of people can't stomach that. So builders are holding off.
Yeah, and just puts more pressure on the rental market.
Correct.
So another thing that I'm getting asked a lot at the moment is, if I'm buying an investment property, what are the tenants likely to be wanting to see in that rental home?
Very good question. I think it's not just tenants, Andrew. I think it's tenants and owner occupiers.
Yeah.
These were statistics, or these were results that came out in 2021. I was just looking up the top key search words in realestate.com.au, and some of the top key search words were space. So because people are working from home more and more these days, companies are starting to treat that as the norm. What they want is, they don't want to live in a tight 2-bedroom, or let alone a 1-bedroom plus a study unit anymore. They want a 3-bedroom, or they want a 4-bedroom, particularly with young families.
Yeah.
So what I'm finding is tenants and owners that are looking for properties, they, instead of living in a 2-bedroom, they prefer a 2-bedroom plus a study, or they prefer a 3-bedroom. So space has become a very desirable commodity. Because you're working from home. So if you have 2 kids running around, you can't exactly work in the kitchen space. You can't exactly work, in your living area, you've got to have a dedicated room to be able to do that.
Yeah.
So the demand is more and more space, which means more and more rooms. That space includes outdoor space as well.
Yeah,
I know, because I've got a 3-year-old, or just about to turn 3. And she loves the outdoors, so I can't imagine not having outdoor space for her to run around, which is going to drive us crazy, so I think having space is incredibly important. That's what they're looking for, space and home study. I'm also finding a lot more people wanting to live a little bit in the outer suburbs. So in the past, people are happy to live in inner city, in high rises, in community living sort of type developments. But what I'm finding now is, because you could work from home, I'd rather live 2 blocks away from the playground, or from open space, from a field, so they can go visit. So that's what I'm finding tenants to be looking out for.
Yeah, okay. And that's, it's a move away from inner city to more suburban locations, isn't it?
Correct. Yes, indeed. Yeah.
So then the flow-on question from that is, how does a landlord take advantage of these aspects that people are looking for to generate a increased rental income?
Yeah, really good question. So here are my thoughts. If you're going to be buying an investment property, what you got to look out for are those things. The space, the extra room, the study, a little bit of an outdoor space, a courtyard, I think is very important. A lot of natural light is what they look for as well. Proximity to playgrounds, to open spaces, proximity to childcare centers, proximity to schools. Really good schools is a really big one, because they can afford to live a bit further out. They're a little bit more selective in terms of the suburb and the street they want to live in. So I think if you choose a suburb, or you pick a location where you can have access to both public, maybe private schools as well, is a big thing. Access to university, certainly public transportation is a big one, because they live so much further out. And sometimes they just want to take public transport into the workplace. So I think access to public transportation, but also shopping centers, places with amenities is a big one. I mean, it's really the norm, but I think what you have to really understand as an investor is, how do you find suburbs with, more owner-occupier appeal? That's probably the big one for me. Because when you find a suburb with a large owner-occupier appeal, you'll probably be able to see that suburb is close to a lot of the amenities which I'm talking about. So I'd much prefer, to advise my clients on buying properties with a higher owner-occupier ratio compared to suburbs that have got a higher investor ratio.
Yeah, and all of those features that you talked about are really important. But again, as a landlord, if I'm able to bring to market a property with all of these features, what, just in estimate terms, what type of percentage do you think a property like that might achieve in additional rental income compared to something that doesn't necessarily have those features?
Yeah, really good question. I think it's both aspects, though. It's the rental income you're going to get out of it, because I know as a property investor myself, I'm seeing my properties with larger land content closer to proximities of amenities. Those ones are generating me at least 15 to 20% more rent compared to areas that don't have those facilities, those amenities. So just from myself personally, I'm observing a 15, maybe even 20% uplift in rentals, which is very strong. I mean, but also I look at the vacancy rates as well. So it's driven by both. It's not just, proximity to amenities. It's also largely driven because the properties that I've purchased are very much in owner-occupier suburbs. So invariably, that's a very, very tight market. I mean, one of the suburbs I've bought into, I think it's got a 0.3% vacancy rate.
Yeah.
So there's just not enough properties out there. So everyone is, pardon my French, but it's a bit of a shit fight out there to get properties. I'll never forget, I got my rental manager ringing me and say, Colin, I'm not even kidding. Don't blink your eye, but you have about 15 applications. 15 applications. Well, it's up to you how you want to choose this, but can you imagine, Andrew, 15 applications? So because of that, I can, we softly say, well, you can offer it, and the highest offer will get the property. Obviously it has to check out as well, but so there's certainly a lot stronger demand for properties that I find that are in a tighter market for sure.
Yeah, it's totally right. My kids had a similar experience last year when they were looking for properties, and they were, one of 20 or 30 applicants at the time.
Exactly.
And it's just, how do you separate yourself from that other than by offering a higher rate, which is, it's just tough. But like you've said, if you've got a property that has all of those features that people are looking for, then 15 to 20% additional rental income is not unheard of, which is in a market with rising interest rates and all that type of stuff, that's the type of way that you manage those rising interest rates, by having that stronger rental income, of course.
Exactly. But also, I think to couple that, I mean, you've also got to consider your capital growth as well. So, if you buy the right properties in the right location for the right price, you make money when you buy into properties, not so much when you sell it. But if you buy into the right property with inbuilt equity in the right location, with good amenities, access to transportation and all that I've mentioned, then your capital growth demand would be a lot stronger in those suburbs as well, because the people that would pay more for your property down the track when you do the valuation is really the owner occupiers with an emotional, I guess, approach to purchasing your property. So they don't mind paying 30, 40, 50, $100,000 more than what you've advertised it for, because it's just so much in demand.
It's what they want. Yeah, that's right.
Correct.
So the final question I've got for you is, again, it's another flow on, I guess. You're a property investor, and your interest rates are going up, and you're hearing a lot about how markets are tight. And you just mentioned there's a market that you're invested in where the vacancy rate is 0.3%, which is ridiculously low.
Correct.
So what, I guess, factors should a property investor take into consideration when they are looking to increase their rental rates? So, I know a lot of people will talk to me about, I'm worried about putting my rate up because the tenant might move out. How do they overcome that fear and understand the best way to package up how to increase their rates?
I'll probably give you a real example, and this only happened to me a few months ago. I was about to, increase the rent for my property, largely because my property managers have said, Colin, we reckon your property should be rented out for X, which is only about $20 per week more than what it was. And mind you, I've already increased that 6 months ago. So in the renewal stage, we look at the market rent, and it's market rent. I say don't fear, because as long as you do your due diligence and you know what your market rent is, don't be penny wise, pound foolish. I mean, if the rental market says it's 600, don't go put 650 for it. You may want to push the envelope and go maybe 610 or 605. But the way I look at it, I'd rather go 595 if it's a looser market. But now I'm going 600. If that's the market rate, I go 600. But what makes me different is that I say to the property manager, okay, for 600, I know it's the market rent, but can you tell me, for this tenant, can you ask the question? The question you ask is, what can we do to make it worth your while to have another $20 or $30 increase on that rental property? And it was such a simple question, but she rang the tenant up and basically said, hey, tenant, obviously you've only renewed it 6 months. We know the market, it's gone up already. We're going to increase the rental property realistically by $20 a week. The owners are proposing that, if there's something realistic reasonable rather, that the owners can do to increase the rent, would you be happy to consider it? And you know what the tenant said? The tenant said, well, actually, would love 2 fans to be installed. One in our living area because it's getting into summer now, it's getting a bit warm. We don't want to use a portable fan, and another one into our dining area. If you'd like to maybe consider installing a couple of fans, that would make, we'll be happily pay an extra $20 a week. So guess what we did? We got a quote. We spent $450 to install a couple of fans. Bob's your uncle. So I'm getting $20 a week extra. So sometimes you've got to really understand you got to take a proactive approach in managing your portfolio, and take be a landlord with a difference. So ask your tenants, what do they want? I mean, sometimes they come back with the smallest things, like installing a freaking fan. So those are the small things that you can do. Maybe it's to do a little bit of landscaping. Maybe it's to do a new paint in the property. They really like that. Maybe it's to do sometimes it's just cosmetic. Maybe they have an issue, and you never know unless you ask. Maybe there's a bit of an issue with the driveway that they'd really like, to be cleaned or fixed, or, so I think you just take a proactive approach.
Yeah, and that's a really great example, because I had a very similar example with a property of mine, and they wanted an air conditioner. So same scenario, I put the air conditioner in and got an extra $40 a week.
That's right.
Now, similar to your example, it's effectively like going to an ATM machine and putting $1 in and getting 2 out.
Exactly.
Because that's effectively the maths of what we've both achieved with, you with fans and me with an air conditioner. And the benefit of doing that is you've got a happy tenant.
Yes, and the flow and effect. I mean, so you benefit the tenant, they happily pay the $20 or $40 a week extra in rent, not begrudgingly.
That's right.
They're happy to do that. But also what I'm finding now, because of the interest rates rising, what banks are looking at is your total income. So every dollar in your rent counts towards your serviceability for your next property and your next property. So not only are you paying down on your mortgage quicker with your increase in rent, but the banks would look at your increase in rents as a favorable factor in determining your serviceability as well for your next property. Yeah.
Awesome. All right. So they're my questions for you for this call. So over to you.
Yeah. So Andrew, I have been observing a lot just in terms of what's happening with our population and our aging population. According to the Australian Treasury report, I think they put out an intergenerational report back in 2010. So that was a number of years ago, but they predicted by 2050, a quarter of Australians will be over the age of 65. 65 being the age of retirement. What they're suggesting is, 1/4. A quarter of Australians will be over the age of 65. There's also a report that was out by the Australian Treasury, the Australian Human Rights Commission. They put out a Face the Facts report, and they suggested that at the moment, there's about 80% of Australians over the age of 65 that depend on the age pension. So I looked up the latest age pension rates, which is really from 20th of September, and that's a single is about $1,026 per fortnight, and a couple is about $773 per fortnight. What worries me, Andrew, is that by 2050, we working Australians will have to be funding 80% of all retired Australians. So if my predictions are correct, 2050, we're 26 million. By 2050, we'll have 36 million Australians. That means there will be 9 million Australians over the age of 65. So what worries me is that, yes, we're sitting pretty now at the moment with the age pension, and then you've got the superannuation rates at the moment. I think a single man at the moment is collectively the age of 65, you probably have about 300,000 in super. For a female, I think you're looking at about 200,000, if at all, in your super collectively. The bottom line, the message is, I just don't think it's ever going to be enough for people to live a relatively comfortable life. Certainly, I don't know if the pension's going to be around. I don't know if there's going to be enough super. So my question to you as an investor yourself, what tips do you have for people who are starting out or really thinking about getting on the investment pathway? They're really worried. But what are some tips they can think about to start to prepare themselves, to ready themselves for retirement, knowing very well that your pensions may not even be there by the time, 30 years down the road?
Yeah, look, this question is kind of like opening a can of worms for me. I did a webinar for a contact last week, and this conversation, on its periphery came up. And we were talking about the fact that superannuation for Australians is not going to be enough. And your statistics have just highlighted that. And one of the stats that always upsets me is that 95% of people will retire with less money than they need to maintain their lifestyle or to live the lifestyle they want to live. So 95% is scary. And like you said, with a quarter of the population on some form of, or in retirement, it's a lot of pressure on government to support them, which they just won't be able to do it. So we have to be proactive. And it's something that, I promote to my audience and to my clients all the time, is that you have to take proactive steps now to get yourself in a position where you're not dependent on the government or superannuation only to support your lifestyle. So you've got to get, your money that you're making now, you've got to get it working for you. So I tend to operate in manage, protect, and grow. They're my three pillars. So in terms of some tips for what you can do right now, the first thing is you've got to get in control of your money. So you've got to manage your money now and put a little bit more of it into the growth phase. So, one of the things I've observed, throughout the pandemic and even now, is that people are still spending quite, I wouldn't say flippantly, because that's a judgment that I shouldn't make, but our spending is still very, very strong. So people are spending a lot. And I think the time is coming, if it hasn't already, where people need to probably just rein it in a little bit and get more of the money they're making now into investing, so that they can have that length of time and use the power of time and compounding to, with whatever time frame they've got, to get to 65 with some assets that are working for them. So one of the great joys I had with a client was when she realized the amount of money she would need to manage her lifestyle was a lot less than she thought it was. So that is, I guess, one of those counterintuitive things, is that some people think they need an enormous amount of money to survive in retirement, which is not necessarily the case, but you've got to have some. And so, my first tip is to manage your money a little bit stronger now and get so that you've got more available to put into the growth phase.
Can I just pause you there for a second? Because you're talking about manage. Something my mum always reminded me is to spend less than you earn.
Yes.
It's incredible how many Australians are living on credit. I just wanted to pick your brains on this, because I have a number of young investors that when you look at their spending habits, it's really quite scary. But what's your thoughts on credit, and how should someone manage their money practically, particularly for a young person?
Yeah. Look, my thoughts on credit is that there's a time and a place for it. And certainly when you're investing, that's where the place is and the time. But when I teach people about managing their money, the first thing we do is we throw out a budget. I don't believe in budgets at all, and that might surprise some people, given that I'm a wealth coach. But I have this other thing that I call a money planner. And what it does is it smells and looks like a budget at first, but then when you take it through to the second and third phase, it actually becomes what is a tool that creates an environment for success with money. And one of the things we do in that process is we remove credit cards, and we rely entirely on using debit cards. So they have the functionality. They have the functionality of a credit card, but you're only ever spending your money, not somebody else's.
Correct.
So you don't get yourself into trouble with credit. So part of that process is actually sitting down and understanding your lifestyle costs and your expenses and all that type of stuff. And like you said, making sure that you spend less than you earn. So you are not living off credit, because
correct.
I talked about time and compounding is often described as the eighth wonder of the world. And that's great when it's working in your favor. But when it's working against you, it's just as great, but not for you.
Correct.
And so if you're living off credit, you're effectively trying to win the battle against compounding, and it's a losing battle.
Absolutely.
So, a really key feature of managing your money is, like you said, is sitting down, spending the time to understand how much you are spending, and making sure it's less than you're earning, and then creating a gap that's big enough that you can use some of that money to grow your wealth. And we call that, and you'll have heard this term, but we call that your pay yourself first money. So a lot of people will spend 40 hours a week working in a job that they don't necessarily like, and none of that money that they make, they keep.
That's right.
It just gets spent, and they go back to work the next week and do it all over again. So you've got to pay yourself first, and we use the money planner process to make that happen.
Yeah, brilliant. Thank you. And I think you had your second point. So manage your money is the first tip.
Yeah, so manage is the first one. Then the second one is protect. So protect is all about making sure that you've got the right security in place, so that if something goes wrong, you're covered. So that's normally in the form of insurances.
Sure.
It's also in as you start growing your wealth and growing your assets, you want to make sure that they're protected and secured as well. So that's the risk management phase. And then, like I said, the third phase is growth, where you get that pay yourself first money into assets that are going to grow your wealth, so that when you get to that retirement age, you have the choice of what you do, and you've got the assets that are going to derive additional income. So if there is a shortfall between your super or a pension, if you qualify for one, then your assets can top it up. And hopefully for most people, if they start taking action now, you won't need that pension. And let's face it, those pensions are not, you don't really want to rely on a pension, because they're just not they're just not valuable in terms of how much money they're going to give you. So you want the assets doing the heavy lifting for you.
So manage, protect, and grow, basically. That's great. Thank you, Andrew. I've got one last question, and probably going to shift gears just a little bit, just because you obviously you're high level, you help investors to invest and think about their money. One of the things I'm curious about your philosophy is diversification. So there are people that say, I know Warren Buffett certainly says that only invest in what you know. What happens if you don't know? What happens if you don't know property? So does that mean you don't invest in property? But I don't know much about shares, so that's why I haven't really put a lot of money in shares myself. But what are your philosophy about diversification? I hear a lot about making sure that you put your money in different places. My diversification portfolio is basically buying properties in different cities. So that's my diversification. But what are your thoughts on that?
Well, diversification is actually a really interesting topic that I could spend hours talking about, but there's different forms of diversification. So there's asset classes at the highest level, so stocks, property, and other assets. Then there's diversification within those asset classes. So like you said, with property, it's different states, different suburbs. And then there's another one that a lot of people overlook, and that's time. So, diversification in time could be, you might have some assets that are all about short term and others that are longer term. That is still a form of diversification. So being a Warren Buffett fanboy, I understand the concept of only investing in something that you understand, which doesn't necessarily mean you have to know absolutely everything about either the stock you're investing in or necessarily the property. Property is a little bit easier because there's not as much to learn.
Yeah, that's right.
But you do need to understand why you're investing in something and why it is that it meets the criteria that you've created or you've learned to invest in it. So that's a key part of it. But in terms of diversification, simply put, I am a big fan. I'm not in the camp of stocks only or property only, and there's plenty of people out there who are very strident on their views on one or the other.
Yeah.
I believe there's a place for both. I believe there's a place for multiple assets in your portfolio, and that's because of the whole economic clock and the way markets move. You want to be able to take advantage of all of those market movements throughout, the term of your investments. So, and it's why I teach people multiple asset classes, so that if they have a favorite, they can invest in that, but they also know how to invest in other categories if they're looking for further diversification, whether it's outside of property or whether it's outside of stocks. They've got the knowledge to be able to invest in other assets so that they can benefit from the market movements in each of them.
Yeah, Andrew, I think property can be simple, but it can also be quite complicated. I mean,
absolutely.
It just depends on how you look at it. I think there's a lot of intricacies which I think one investor needs to know, and that includes the pros and cons, the implications of what happens when you get into property. Properties invariably are longer term investments, and just to your point, right. Time is probably a big factor as well. So do consider some short term investments that help build up your deposit or your cash position to invest in the bigger things that are going to set you up for the long term.
And that's an important part of that diversification conversation, is that property is, an investment that you're not making for the next 5 minutes. You're going to be tying a substantial amount of money up in an asset that you want to hold for at least one property cycle, if not more.
Right.
So it's not like a stock that you could get in, decide you made a mistake and get out of really quickly. Right. So that is also diversification in its sense as well. So it's a big topic that you have to explore a little bit more to understand the full gamut of options.
Correct. Well, that's me, Andrew.
All right.
Back to you.
Excellent.
Mate. Yeah.
Well, thanks again, Colin, for the opportunity to talk about money, wealth, property, everything that's happening in the markets. It's always great to get your insights, and look forward to doing it again shortly.
Sounds good, Andrew. You take
Excellent.
care. Huh? Have a good day. See you. Bye-bye.